All right, Andy, we're here again to talk about the Southwest Airlines market-based cash balance plan, MBCBP. All
That's
right,
right.
that's the most
That's
important
right.
thing that you get right is that acronym saying that. I've practiced it
Don't
a lot.
swap, don't swap your P's and your
Yeah,
B's.
MBCBP. All right, so I've got it down. But today we're going to talk about what is it, the big picture moving parts. What is it? Why do we like it? And we will share our opinions on that. Should you max out the market-based cash balance plan? How do you max it out? What if you don't want to put anything in there? We're going to talk about how to arrange your contributions in your 401k such that you either max out the market-based cash balance plan or you don't put anything in it. Because
Yep.
there's no, like you mentioned earlier, there's no little switch to go in there and go, no, yes, like there is in the 401k essentially. So you've got to pull some levers. And
That's it.
some, depending on income, may not have a choice anyway. So we'll talk about that. So the last thing that I want to talk about, if people stick with us to the end, we might have to divide this into two, Andy. We're going to be careful in our time here, but I think there's an opportunity if someone gets the maximum into the market-based cash balance plan, that's going to save them taxes because that would have been taxable income previously.
That's right.
My idea is to offset that tax savings with Roth 401k. We'll talk about that at the end. But what do you got? Big picture stuff before we jump into the details. Anything on your mind?
I think you nailed it. I think you nailed it.
Okay. So let's just go over to some big picture stuff to just everybody caged. Everybody's gyro is caged here, so to speak. But so
Sure.
what is the market-based cash balance plan? What's your best way to describe it?
Yeah, it's essentially, I think of it of another savings mechanism for retirement, right? And so that was something that came out of the new contract is, hey, if we're, especially now that we have these larger non-elected contributions, this was the whole genesis of it. How do we mitigate that taxable income, right? That's going to start spilling over, if you will. So really it's just thinking about like, hey, it's another retirement vehicle for me as a pilot, is the way I think about it. I don't know, what do you think, Charlie?
Yeah, I'm going to throw out a couple phrases to help. I mean, I think it is
Sure.
a hybrid pension slash 401k. The SWAPA website does a good job of describing it. It says it has features of both. So what that
Hmm.
means is you're going to get some contributions going in there. That's real money. It's going to be tied to a 40 stock, 60 bond type portfolio. And but you'll have that guarantee that the contributions, your balance, regardless of the market performance, will never go below your contributions. So that's the important part. That's where the pension part comes in.
Yep.
Relatively conservative in investing. Southwest Airlines is on the hook. So that's one thing I think about is that blend hybrid, 401k slash pension. So it's a good plan for that.
Yeah, and I think part of that, people may be, I don't know, frustrated maybe isn't the right word, but they may think, hey, if I could just get that money myself, right, I could invest it more aggressively than this sort of conservative 40% stock, 60% bond, which is maybe true, right, over long periods of time, but it's getting backstopped, right? And so
Mhm.
there's some power there as well for my option friends, right? It's sort of like you've kind of got a put option, right? That is, and the premiums on that option, which are generally, usually expensive, are being paid for by Southwest Airlines, right? So I think there's some goodness there. And yeah, it's a little bit more conservative, but um, it's as you noted, right, Charlie? It's never going to or below your contributions, right? So there's goodness there.
It's one of those things, Andy, that's not so sexy when the market's up. Like, man, this cash balance plan is
Yeah,
lame. And then the market
right.
tanks, and you're like, wow, I'm kind of glad I have this, conservative slice.
Totally.
But it's gonna, we talked about how might that affect the risk um, of your overall portfolio. It's going to take a while for this,
Yep.
the cash balance plan to build up such that it has a meaningful impact on your overall risk. In other words, you got $1 million in your 401k, you're going to get $16,000 maybe in 2025. Not going to have a meaningful impact. It's going to take a while,
Yep.
So if somebody is getting a lot of money in this over the years, they decide that, hey, I've got this conservative piece of market-based cash balance plan. Maybe I can make my 401k a little more aggressive to offset and think of it as one pot of money there, so to speak.
Yeah, absolutely.
Excellent. Two methods of funding. We've already alluded to it a little bit. Right now, 1% of a pilot's pay will go into this market-based cash balance plan for 2024. Now they are still pending, I think, some implementation, IRS, approval, whatnot, but that has already been set aside by Southwest Airlines. For example, you make $300,000 this year, $3,000 will go in the market-based cash balance plan for 2024. Now, that is still subject to the 401(a)(17) income limit of $345,000. So you make $400,000 this year, you're only going to get $3,450 in there because it is subject to the 401(a)(17) limit of $345,000 this year. Now, you'll still get that money. You'll still get 1% of all your income, but not all of that can go in the market-based cash balance plan. So hopefully I said that clearly.
Yeah. Yeah, I think that's right, Charlie. So the way I think about it is Southwest is always going to pay you the 1% cash balance plan, 17% non-elective contribution. Like you're always going to get that money. It's just where it goes. And that's an IRS consideration. And I think the other piece of this, Charlie, is who's even eligible, right, for the cash balance plan. It's a little bit different than like the 401k, right? So you've got to be essentially, at the company for a year to even be eligible for these contributions. Probably not a player for the spill cash because we'll talk about that in a little bit and why that's maybe not true. But the 1-2%, you've got to wait a little bit more than typical.
Excellent. That's good. I'd forgotten that point. The last things here before we get into the nitty gritty. And again, we don't want to gloss over this. We're going to revisit some of these things, especially this bold that we have here, 270K. That's when the spillover will start. So for those of you new FOs, maybe you're not flying as much senior FO, or even, I'm not sure if a captain could get to 270. If they try, they have to be part-time on these new pay rates. But anyway, if you're 270 or less, you're not going to get 401k spillover into the market-based cash balance plan. So you just need to think of, it's going to be 1% of my pay or 2% of my pay in 2026. And we'll get to those details in a second, what that looks like. So Andy, we love it because it's essentially more NEC, and the negotiating committee, Damian, Jeanette, and those guys said, hey, look, we can get more NEC than soon to be 18% if we go the route of the market-based cash balance plan. And it's awesome. It's a qualified plan versus the non-qualifieds. Non-qualifieds, as people know, are subject to airline bankruptcy. You get in line as a creditor. Qualified funds are yours regardless of company bankruptcy or whatever. And then the last bullet there we have is you've got some flexibility. 59.5, you can do whatever you want, roll it to your 401k, and then eventually an IRA if you want to. So those are some flexibility, a lot of options that you don't have with the non-qualified programs.
Yeah, 2 points I'll add on that one is if you break the numbers down in 2026, right, that's like 20% of your pay. Not like it is 20% of your pay, right? That's being provided by the company, which is without you putting a dollar in, right? Which is huge. And then the other piece you mentioned, Charlie, on that qualified, non-qualified is, and a little bit's in that rollover is those non-qual plans, right? It was lump sum or 5-year distribution. Here now we get to take advantage with this market-based cash balance plan, right? Of rolling into that IRA, not having it subject to being pulled out in taxable income until RMD age, right? So just so much more flexibility.
Absolutely.
The fact that it's a qualified plan.
Yeah, that 20% you're talking about took me a second to catch what you were saying, but in 26, you're talking about the 18% NEC in 2026, and then the 2% contribution to the market-based cash balance plan. Again, if you read a lot of generic retirement magazine investment advice, how much should I save? It's like save 10 to 15% of your income. 15% is a lot. Well, 20% is happening without a Southwest pilot lifting their finger. They're just 20% right off the bat. I'm not saying that's the right number to be saving. You might need to save more. We don't know. But it's a lot to give you some flexibility. So that's awesome.
No doubt. No doubt.
All right. Here we go. Let's see. We probably covered. I bet we got ahead of ourselves. No, we didn't. So let's see. Should you do it? Right? Should you do it? I just thought I'd throw this in there real quick, Andy. And it's like, man, that goes to that 20%. hey, you're getting 20% savings. Is it enough, first of all, for retirement, which probably should be your priority? But then, there's folks out there that they've got 4 kids, and their oldest is 17 and their youngest is 12, and they're getting ready to get shellacked with college bills. So,
Yeah.
so maybe that's a scenario where you go, maybe we can turn off the 401k for a bit, allow Southwest to do the heavy lifting, pay for college, depending on priorities. Again, that's very specific circumstantial type stuff, but those are some scenarios where you think like maybe I can let Southwest do the heavy lifting. If I want to get my emergency fund up to speed, I've got kids going to college. I need to, get that started or funded somehow. But I don't know, Andy, anything you think there?
No, I mean, I think all that is true. And I think as we talk about, should you fund the market-based cash balance plan, right? There's no toggle on the Empower website
Hmm.
that you go in and you say, yes, contribute this much, like you do on the 401k, right? Set aside 12% of my pay. So the mechanisms of which we'll get into here and probably on the next slide, right, is the mechanisms with which you fund that cash balance plan, right, is going to be entirely up to sort of like how you manage your contributions into the 401k. But that's obviously a different discussion on should you, right? I think everything you just said there is 100% 100% valid, but it's kind of now we're in the how do you do it, right? That's the next step.
Yeah, let's dive in. Let's see, how does this work? And we've covered, the first couple of bullets there, 1% of your pay or 2% in 2026. Now we can get into the nitty gritty of, I wrote that statement there in bold, above the 415 excess limits up to the 417 limit. Now, I know a lot of people are like, what the heck does that mean? We're going to talk about that and try to demonstrate how money gets into the market-based cash balance plan, because that's very important. And let me throw this basic thing out there that I think is really important. And that is, if you don't do anything and you make $345,000 or more, you're going to get, what's the magic number there? $58,650 in your 401k. So you don't put anything in your 401k, you make 345,000 or more, 58,650 is going to go in your 401k. That is obviously lower than the IRS limits of 69,000 or 76,500 if you're 50 or over.
Yep.
So you got some work to do. Um, if you want to max out that IRS limit and nothing else, no spillover, then the magic number for you, let's see, I got to check my notes here, is, help me out,
And
10,350.
yep.
So take 10,350, divide it by your pay, get a percentage, and that's probably what you should do, to
Yep.
get zero money in the market-based cash balance plan and max out your IRS limits. Andy, did I say that right? Help me clarify if I missed anything there.
Yeah, nailed it. Nailed it.
Yeah.
And I think the important caveat there is that's for someone who makes $345,000 per year or more, right? Because then the numbers are going to be a little bit different if you start going under that. That's, as you noted, right? It's 270 to 345. That's that window of we're going to have some level of spill
There
cash
you go.
into the cash balance plan, assuming we contribute the full 23,000 401k limit
Perfect.
into the 401k.
Let's jump into that junior FO
Yeah.
and just kind of look at those 3 examples: junior FO, senior FO, and then captain, and we'll see what we can learn here. What do you think? This is you got a 3-year junior FO up here flying 95 trips a month, and they're
Yep.
contributing 12% to their 401k.
That's right. Yeah. So I think first thing is 12%, right? That's going to get you the 23,000. So good job to this hypothetical individual, right? They've maxed that out. But I think the important thing here is you're not going to get money into that market-based cash balance plan from spillover, right? You see this here, this is the 1%, but there's not going to be any spillover because there's really no way for us to get $69,000 or more with the non-elective contribution plus your 23,000. So as this individual here, we're really not in this, we'll call this I don't know, the splash zone, spill zone, the SeaWorld first two
Yeah.
rows, the SeaWorld Shamu. We're not there yet, right? We're not there yet. So, you've done everything you can. You max out your 401k, you get your 1 to 2% plus the 17%. But until you get to the 46,000 of non-elective contributions, right? Which equates to, Charlie, as you were saying, 270,000 of income.
Yeah.
Until you get to
Bas-
those numbers here.
Yeah, I'm sorry to interrupt you. You just took your, the 40,000. Well, you could take 270,000 multiplied by your 17% NEC, and that
Yep.
gets you to 46,000, right?
Yeah, give or take. There's a couple other dollars
Yeah.
hanging around out
Yeah.
there, but those are whole numbers.
There you go.
Yeah. So I think that's our junior FO.
Hmm.
And we'll chat about, what is a senior FO. So what do you think here, Charlie?
Yeah. And you change the contribution to 10%. I don't think that's terribly impactful unless it got really low, then it would be,
Yep,
right? So 10,
that's
in other
right.
words, 10, 12%, we're going to have the same lessons learned here. Now, we'll try to quantify, if you don't put enough in there, then Southwest Airlines is going to squeeze out yours and you might miss out on that, but we'll get to that in a second. But it
Yep.
looks like this FO I can just do the math there. Let's see. No, I can't. They hit the $69,000 limit, uh, and so Southwest has to stop contributing to that 401k once that number is hit, and that is between the pilot. The pilot hit $23,000. You can see where the orange stops there in October. So
Mhm.
then the 69,000 number hit. Looks like in mid-December is when that $69,000 number hit, if I'm reading
Yep.
the colors right.
Yep.
And Southwest like, oh, we got to stop. However, we're not to the $345,000 limit yet. So that $345,000 limit, they can go, all right, we can still give 17 percent of that, and but it's got to go into the market-based cash balance plan.
That's exactly right. That's exactly right. Yeah. So this is someone, oh, by the way, right, this is the top of the FO pay scale here.
Yeah.
If you fly your normal, I don't know, Charlie, with 90, 95, kind of your average,
Hmm.
right? This is you got to get to over 105. Now, of course, it doesn't take in any of the nuances of the pay and
Yeah.
the pay for trips. But again, the takeaway here is this is someone making about 280,000, right? So you've got to get your income over 270, as we've been sort of harping on that number throughout the discussion today,
Yeah.
to even start contemplating this spillover into the market-based cash balance plan.
Yeah, absolutely. So it's I think the big lever here is that this pilot maxed out their 401k
Yep,
and their income. Those are
that's
the
it.
two levers that you got to think about there a little bit. So
Yep, yep, exactly right. Should we go to the left seat?
let's do it. Let's see. Let's upgrade. All right.
So Charlie, now we start talking the captain here. We'll do the year 8 captain. So
Mhm.
that's 307 60, right?
Mhm.
Doing your standard 95 trip. So this is the example of what's the most I can get into this cash balance plan as spill, right? Because
Mhm.
we are, as you noted, Charlie, also capped at that number as well. In other words, everything's not just going to spill into that cash balance plan, right? We're still subject to that 401a 17 limit of 345,000 for Southwest Airlines contributions before it becomes taxable income, or what we call spill taxable, right? So
Yeah.
this is that example. Hey, the pilot still puts the 23,000 in, and then you can see Southwest, right? They put 46,000 into that 401k, and that gets us into that 69,000, right? So all that happens now around October, assuming we're putting 10% of our pay in, and that's when that spill really starts happening.
Yeah. Yeah. So just to reiterate, again, this resonates with me. Southwest hits that or sees that $69,000 limit. Bam, they have to stop everything going into the 401k has to stop. They switch over the non-elective contribution to go into the market-based cash balance plan up to $345,000. Then they have to stop there again. So that's in that 345 we keep saying is a 401a17 limit. So that's why I was talking earlier.
Yep.
You got the 415 limit. That's the 69,000. That's one boundary where they stop on the 401k. They switch over to the market-based cash balance plan until the 401a17 limit of 345. Then they stop there, and then it goes into your check after taxes.
Yeah,
Did I say that
that's
right?
exactly right. You did it. Yeah. So we'll muddy the waters a little bit more, right? So 401a 17, 46,000, 12,650, 58, 650, right? Between those two numbers there. So you can see that's the most we can get in here. And then Charles, you noted, right? Still 401a 17, 1% of 345,000, 3,450. Once we exceed those numbers, right? Because Southwest is contractually obligated to provide 1% cash balance plan, 17% non-elective. Now we get what we call the spill taxable, and this is coming to you as taxable income.
There we go. So I think
Previously, I was saying, previously, right before the contract, right, this 12,650 was all coming to you as taxable income, right? Which is sort of kind of what you were alluding to, Charlie, of, hey, we're getting this tax benefit now. How can beyond what we're already being able to take advantage of, which is save taxes and get tax deferred growth in a qualified plan, how are we able to take maybe further advantage of that?
Absolutely. Yeah. So, that 12,650, that, like you just said, would have come to you in taxable income unless you were using the non-qualifieds, which most people don't until they're 60 and beyond. So that saves you, if you're in the 24% marginal tax bracket, that would have saved you $3,036. And the 12,650 going into the market-based cash balance plan, if you're in the 32% tax bracket, saves you about $4,000 in taxes. And so, $3,000 to $4,000 in tax savings because of the market-based cash balance plan if you're maxing it out. So that's phenomenal. You got two choices now. As a high-income individual, because you're high income if this is happening in the eyes of the IRS, you can capture that tax deduction, that tax savings, and you can be happy and like, sweet, we saved some taxes. Or what I might think about doing is going, hey, I'm going to turn on my Roth 401k to maybe offset so that maybe I'm tax neutral from the year before. And again, you could take the tax savings and run, or turn on a little bit of 401k contributions, and that is a great tax advantage down the road when you're retired. Gives you flexibility, lots of other benefits that we've talked about before. But what do you think, Andy? Is that all make sense?
I think so. Yeah. I mean, I think just as you said, Charlie, the net tax benefit to you is the same last year's as this year, even if you put the 12,650 into a Roth IRA, right? So you're getting this again, the same tax benefit. It's just Southwest is helping you out along the way here, and now we get to take advantage potentially of Roth. But you're right. You still always have the option, just as you said, take the tax benefit.
Stick it
Thank
to
you
the
very
tax
much.
man and run.
Yeah, and move on with your life.
Yeah. Me personally, I look for every opportunity to get money into that Roth. You said
Yep,
IRA there. I think you meant Roth 401k possibly, but
I did. Yeah,
okay, yeah,
thanks.
Roth 401k,
Yeah,
because if we do the backdoor Roth IRA, then there's really possibly no tax implications there unless I'm converting pre-tax IRA. So I know that gets a
yep.
little bit off our topic today, but the point here is it's an opportunity, make a decision, be intentional about it. And again, if it were me, I might turn on a little bit of Roth 401k to offset that, just to stay tax neutral, and make an investment there and some future tax-free money to mitigate the risk of higher future tax rates.
Absolutely.
All right. Andy, as we wind down today, what are some takeaways for our pilots? Just super simple. I want to think about if I want money in there, or if I don't, what do I do? What do you think?
Yeah. So I think the big takeaways today are if you're not making $270,000 per year, then you're not even in the spill cash
Mhm.
discussion yet. That's not to minimize the fact that you made $270,000. It's just for the purposes of the discussion, you're not there. And then if you're in that middle zone, the 270 to 345, right, you and beyond, in order to influence that cash balance plan spill, you have to put money into the 401k, right? And we've been talking today about putting the full 23,000 in there, right? So you have to make contributions to get this benefit. And I think, Charlie, the last piece there is what you said is, hey, let's say you're taking full advantage of this spill cash. You make over $345,000 a year. You max out your 401k. Could you then offset what you were probably doing pre-tax because you're like, I'm in the 32% tax bracket or 35.
Mhm.
Could you make some Roth contributions and tax diversify a little bit more?
There you go. All right.
What do you think, Charlie?
I like it. I like it. And it's like you said, there's no magic button to turn it on, turn it off. You
Yep.
still have flexibility, but you gotta think about it a little bit. Hopefully it was helpful today. And shoot us an email or call, or you've got Andrew at leadingedgeplanning.com, Charlie at leadingedgeplanning.com. If you don't want to email either one of us, you can go info at leadingedgeplanning.com and somebody will answer you, probably me or Andy. But anyway, you can call our office at 865-240-2292 and get one of us, and we will be able to help answer any questions. And so love to talk about it and help out any way we can. So thanks for watching. Let us know if there's other topics you want us to cover, and we'll do that. We appreciate it, and see you next time.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.